All right, guys. So we're back here with another exciting episode of Ask a CPA. My name's Russell Wallace, and I've got my good buddy here, Brett Phillips, with me today. How's it going, Brett?
Great, man. How are you doing?
Doing awesome. I'm doing awesome. I can't wait to dive in here and get some more tax questions answered.
Yeah, we got some good ones today. We've had a lot of interesting questions that have been posted on YouTube and through the website at askacpa.co. So yeah, I think this is gonna be a really banger of an episode, Russell.
Yeah,
It's gonna be a good one, man. I'm excited.
absolutely. Well, guys, before we jump in, if you haven't yet, be sure you hit that subscribe button, like these episodes, and pass them around to your friends. So we hope you got some good information out of them here, and let's jump in. So this week, we've got some partnership questions. This is going to be kind of a partnership-centered episode, it looks like. And for our first question, we've got James and Robert from Houston. So I've got my business partner and I started a roofing company together 5 years ago, but now he wants out, and we don't have a buyout agreement. So how should we structure the buyout so that I don't get hit with a massive tax bill? All right. So what do you think there, Brett?
Yikes. I mean, partnerships are tough, man. It's always hard when you go into a business with somebody. You want to make sure you have a really tight operating agreement and that you kind of think about, okay, what if this falls apart? What if my partner wants out? What if I want out? What if he dies? What if I die? What if you get a divorce? What happens in all these different situations? So you really want to go into a partnership with a really good operating agreement and hiring a really good attorney to write up a really good operating agreement. They've seen all the different ways that these things can fall apart and what can happen. And, they've got some stories to tell. So yeah, you want to make sure that you hire a really good attorney to write up a good operating agreement. As far as the tax situation goes, if you are the buyer, it's not really going to be a tax situation for you. It's going to be a tax situation for the seller. So your business partner that's exiting the business, it's going to be a potential tax situation for him because he's the one that's going to be receiving the income. Yeah, you could structure this in a buyout where you do it as, over a period of time, over a number of years, where you say, okay, let's get a valuation of the business as of today. As of today, the business is worth X. Let's throw some numbers out there. So let's say we get the business valued. They say the business is worth $3 million and you guys own it 50-50. We don't have all these numbers or the exact ownership percentage in the question, but just for example purposes, let's say $3 million business value, it's 50-50 ownership, and you want to buy out your partner. So $1.5 million, you can structure this, say, okay, over the next 3 years, I'll give you $500,000 a year and then we're done. Or, closely held business like this, maybe you try to argue that it should be a lesser value. I'm not sure. I mean, there's a few ways to take a stab at this. What do you think in this situation? Have you come across situations like this before in the past?
Yeah, absolutely. Absolutely. So, you kind of hit it there in the beginning with making sure you've got a good agreement. And I think all good agreements, it's a tough conversation to have, but they've got to have a buy-sell agreement. While you still like each other, that's when you try to figure all this stuff out,
Yeah.
You think about an operating agreement, it's almost like a prenuptial agreement, right? So you're just trying to make sure that, we don't think any of these bad things are going to happen, but if they do, this is what we're going to do. This is how we're going to handle it. And I like your thought there about trying to structure a deal where they can kind of buy the other person out over time. I mean, one that allows you a little bit more flexibility and not having to go get debt. It allows you a little bit more flexibility in negotiating things like the interest rate, but also, from the seller's perspective, and a great way to sell this idea to them, like, hey, you're not going to get a $1.5 million check. Instead, you're going to get so much money per year. Is that it lowers their taxable income each year, right? So they're not paying. If you get over what is it, about 450. It's indexed for inflation, but once you get over this limit, right, then even long-term capital gains go up from 15% to 20%, right? So keeping the amounts below those numbers and allows that the seller of this equity, the one that's exiting the partnership, allows them to pay less tax over time. I think it's a good selling point in order to try to get a deal done that kind of works a little bit more in your favor. You can always go and get SBA loans. One great thing about SBA loans these days is they're not fixed rates, and so they're usually adjustable or variable rates. And so we're in a high interest rate environment right now. So hopefully that'll come down. The scary part of that is that they may not come down; they might go up, right? And so you're taking on some additional risk there. It's a tough situation, and I think that you've got to have some really open and, to the extent that you can, hopefully this is just somebody wanting to go off and do something bigger and better, not necessarily like hating on each other, right? But, I've seen it kind of both ways. And when the relationship is devolved, it gets really, really tough.
Right. Yeah. I think, any time you go into a business relationship like that, it really is a relationship. Like you said, it's like a prenup. You'd kind of think of it as like a marriage and like, okay, I'm going into it with this person. It's important to think about these things up front and, what could potentially go wrong. Everybody's excited when you first start a business and everyone thinks, oh, it's going to make money and it's going to be great. But when businesses struggle and, distributions aren't as strong as they once were, or, revenue slides, it's difficult, and you have to be willing to work together and communicate clearly and, sit down and make sure everyone's on the same page. I talk to my business partner 2 or 3 times a day. I mean, we're all in constant contact. So it's because, we want to make sure that we're both comfortable in the way things are going and we're making decisions together, and it's not a one-sided relationship. But yeah, that's tough. And yeah, there's a lot of options to structure the buyout. You could do an installment agreement if he wants to, carry the note. You could, like you said, SBA. You could, do like a Robs if you had a retirement plan. You could, self-direct. There's lots of options. We had this happen with a client of mine not too long ago where they had a big medical practice, and one of the original founding partners was a little more absent, and the people that were operating it were like, hey, we really want this guy out of here. He's still, we're still having to cut him a check every month for his portion of the profits, and he's not doing much. And we're kind of feel like we're running everything, and, that's a kind of a one-sided partnership. So they ended up getting an SBA loan and buying out that other partner. And now they're paying on a note, but at least they own all the equity now.
Yeah. So buy-sell agreement, if anybody out there doesn't know what that is, one of the things that it does is it just says that you have some predefined ways to buy the other person out, right? So some of them are, I'm gonna make an offer to you, and then and either that the other partner has to accept that offer, or they have to pay $1 more, right? And that kind of keeps both people honest, right? So you have to make a legitimate offer for that equity, because if not, then the other person's just going to, offer $1 more and buy it out. In our $3 million example, right? So if that 50% is worth, 1.5, and I walk up and I'm like, here's $100,000 for your 50% of equity. Well, they're just going to turn around and say, well, actually, I'm going to buy you out for $100,001, right?
Right.
So that's one way to do it. Another way that I've seen is where they've come up and just basically said, hey, this is what in this industry the value is generally X percentage of gross revenue, right? So like in the CPA world, right? So 125%, 150% of gross revenue for a small CPA practice, that's generally what it's going to start being valued at. And so there's these kind of rules of thumbs, in some other industries, it might be, 80% of revenue, that sort of thing. And so if one of those rules of thumb exists in your industry, one way to do it is just to say, if somebody wants to buy them out, and let's say it's normally 100% of 1 year's revenue, right? So you take the last 12 months, 100% of revenue, that's the value. But if you want to buy somebody out, you want to make sure that, that there's some pain involved and some compensation for the work that they've put in and that sort of thing. And so you might say, well, look, if, rule of thumb is 100%, but you can buy me out anytime for 200%, right? And so then now the other partner has a way out, right? So if they really just don't want to be in this partnership anymore, they have a way out, but you also get compensated at twice the equity value if they kind of pull that lever. So different things, there's different ways to do it, but overall, the best time to work this out is definitely in the beginning. When when you have no business, it's much easier to solve these problems than when you have a $3 million business and you got to like start thinking about all this money involved.
Right. And, and another interesting side of a buy-sell agreement is if you go into business with a partner and then they get a divorce and, say it's 50-50 and then now it's 50, 25, 25 because the wife or the spouse, husband or wife, now has 25% interest in your business and they may not be involved in the business at all. And your like buy-sell agreement could say, okay, I can buy out. If you were to get a divorce and you're not able to buy them out, I have the option to buy them out. So I don't have to be in business with your ex-spouse who has no idea of the business that we're operating, and we have to pay them, 25% of our net profits every quarter or whatever.
Yeah, forever.
Yeah.
And
So
if
you
it's
want
a
to have that
divorce,
option.
yeah. And if it's a divorce, they may not be they may not be inclined to sell if the other spouse really wants them to, right? So,
Right.
It may be a contentious divorce, that sort of thing. So I'm glad you brought that up. I've seen that before too, where it's either you take care of it or I get the opportunity to do so, right? And so I think that's good, because if another spouse is not involved in the business, they don't add any value to the business, then the most valuable thing a business has is its equity. And so you don't want to just like give that away to people, and so you want them to be adding something into the business if they've got equity, for sure.
Yep. Well, cool. Well, thanks, James and Robert from Houston. That was a really good question. The next one comes from Erica in Salt Lake City, Utah, which I love Salt Lake. Man, we used to go to Park Cities all the time and go skiing. It's a great snow up there. She asks, I run a family-owned restaurant with two of my brothers, but we're constantly arguing over money. One of them wants to reinvest all the profits, while the other wants to take big distributions. How should we structure our income to avoid fights and tax problems? Wow, a lot of family issues in this in these questions. This is great. What do you think, Russell? Old Erica from Salt Lake.
Wow, so you've got three people in a family business here, and they've all got kind of competing ideas of, one wants more money, one wants to invest and grow the business, that sort of thing. They probably have different lifestyles and maybe different family situations. And so again, just like, we were just talking about here with James and Robert, the best time to work this out is in the beginning, and the least likely to have worked it out in the beginning is when it's family.
Right.
So here they are, right? So now we're going to try to work this out. If they were my clients, if Erica came in and talked to me, one of the things I would say is try to like sit down and work out what we're going to do with however much everybody's going to get paid, right? How are we going to pay each other, and come up with some sort of fair allocation on that. And maybe it's all the same. Maybe somebody has a different role than the others. Maybe somebody works more than the others. But you can just figure out how much you're going to get paid, right? And if you're in a partnership, you do that through guaranteed payments, right? So if you have an LLC partnership or a general partnership, you don't have the partners aren't supposed to pay themselves payroll, so you use guaranteed payments to do that. And so you can allocate those guaranteed payments to each of the partners, right? So then everybody's paid. Everybody can pay their mortgage, put food on the table, that sort of thing. And so then it's a question of what do we do with the money after that? And so then I'm going to steal this from Dave Ramsey. So I used to just be an avid listener to Dave Ramsey's.
I love
podcast.
Dave Ramsey.
Yeah.
Great advice, man. He's consistent with his advice, which is great.
Yeah. And, getting to hear everybody scream freedom on what was it, on Fridays or something, right? They're debt free, so they call in, scream freedom. That was always a good one.
Yeah. I like his daughter too. Have you listened to her?
No.
Rachel Cruz, I think is her name.
Yeah.
Yeah, same advice, but a little bit younger of a perspective. I think Dave is really wealthy now, and so I think he sees things a little skewed. But it's interesting to watch her as his daughter and kind of the preaching the same type of money behaviors, but through a different lens.
Yeah. So let's steal a little advice from Dave. And so what you do here is that you think about what you're going to do from like a percentage standpoint, right? So look, if we're gonna make any money over this guaranteed payment amount, then now we start applying these percentages, right? So you've got 25% goes into maybe maintenance or capital improvements for equipment, things like that. Another 25% goes into income, and then 50% goes to distributions, or however you want to split it up. But you think about it in these percentages, right? And that way, before there's money sitting in front of people, and it's, money just makes it harder, right? It just brings in all these emotions and things like that. So just sit down with no money and just talk percentages, and everything becomes a little bit more clear. Because then people are like, okay, I think it's appropriate that if we have excess profits, it's probably appropriate that we invest some of this money or save some of this money for equipment when it breaks down, or buying new equipment to be able to increase revenue or something like that. It also makes a little sense to have some money set aside for some marketing or things like that to grow the business. But then you also want to make sure that you're reaping the rewards of owning a business, right? And so now we have some allocations here for distributions. But if you can sit down and think of it that way, then I think this will solve a lot of those problems here. I feel like sometimes we get into some counseling sessions, with some of our business owner clients, right? So they have some problems, and they kind of look at us as advisors, and so they come and sit down and like, so this is the issue, But have you ever had to answer any questions like this in your practice, Brett?
Yes, all the time. It's not uncommon. Everybody has a different idea of how they want to run their business or how they want to take money out of the business. But just like a individual running your personal finances, you kind of need to do the same thing with your business. So you need to have a budget, have an emergency fund, have a backup line of credit. It's always hard to get a line of credit when you really need it. So you want to do that while money's good and, you have cash in the bank. Then you can go to the bank and say, hey, we want, $100,000 line of credit just in case. But when your bank account is running low and you need to make payroll and your savings are depleted, the bank's going to be like, no way, we're giving you a line of credit.
Yeah.
So you always want to do that while the business is hot. And then I think, when you have multiple people working in a business, you want to break it down in two segments. You want to have salary, and then you want to have equity. And your salary should be paid for the job that you're doing, the role in which you're doing it, and reasonable compensation. And then your equity should be based on the percentage of equity in which you own, and that's the equity is usually paid out less often, maybe quarterly or annually, and the salary is what you kind of live off of and is paid out consistently. But yeah, that's kind of what I see in businesses like this, is that everyone has a different lifestyle that they need to live on, and it's important that you're clear with this up front, and that everything is been discussed up front before the business starts rolling. Yeah. So, I really like those questions. You see these a lot. And like you said, we're kind of like therapists when we sit down with a client, individuals as well. When I'll have married couples come in and they'll be like arguing in front of me about their finances. And I'm like, okay, let's calm down and let's talk this out. Why don't you lay down on the couch and we'll figure it out. Yeah, but it's good stuff. It's important to communicate it. It's important to get in front of these things. And if, like I said, they're relationships, and it's important to be upfront and transparent and communicate and do all these things just like you do in a normal relationship. So
yeah, that's right. Well, it's easier to do in the beginning, right? If there's one lesson that I've learned from having a lot of clients, a lot of business clients and partnerships that have fallen apart and those kinds of things, it's that the conversations are hard in the beginning to have, around buy, sell, what happens if we don't like each other anymore, those kinds of things. Nobody wants to think about that, but they're so much easier to have as hard as they are, they're so much easier to have in the beginning. And money just makes all these emotions kind of come up to the surface in ways that you can't always anticipate, right? And so having these conversations in the beginning before emotions are high, but also before there's a lot of money involved, it's so much easier.
Yep, absolutely. Well, cool, man. That was a great episode, Russell. What do you think?
Love it. So
Erica from Salt Lake with her family issues in the restaurant business. I hope that helps, and hope you get some clarity there. And then James and Robert from Houston with their roofing company. Man, that's a tough situation as well. So I hope that works out for you guys. And yeah, feel free to drop a question if you have something. Hit us up at askacpa.co or drop us a question on the YouTube channel or on Spotify. We'd be happy to discuss your question and hopefully give you some good feedback.
That's right. Well, until next time, Brett, hope you're surviving busy season, and we'll chat soon.
Yeah, piece of cake, man. All right, buddy. This is a good one.
All right,
See you,
bye.
Russell.